Hey, good afternoon, everybody, and welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. Here to talk to you about a strategy that I think is important. It's going to wrap up the week, and it's called the poor man's covered call. This is basically a takeoff from the traditional covered call. Own 100 shares of stock, sell a call. So when we think about the setup for a poor man's covered call, first of all, why is it called the poor man's covered call? It's a cute little name, but basically it's another name for a name that has less vernacular than calling it a diagonal. And simply what the purpose of this particular strategy is, let's say that you have an account, $5,000, $10,000, a couple $1,000, up to $25,000. That's, a decent sized account, but they're considered small accounts in the industry. And when you're looking at stocks that are trading at $50, $100, $200, $700, to be able to do a covered call on that, well, it's not even feasible. So an alternative trading strategy that you can start to utilize is the poor man's covered call. Basically, this is for smaller accounts. Now, bigger accounts can do this, especially if you want to be vested in the market, but you're concerned about putting your cash to work. For example, at levels like we see today, right? All-time highs. You have cash to put to work, but you don't want to buy stocks. How do you do it prudently where you can participate on the upside bullishness, but if there's a pullback or if, in fact, the thesis fails, in other words, the market turns, you have less capital out there than something like a traditional covered call. This is how you do it. What you do is you buy a longer term option, an option that has a longer expiration date and that is in the money compared to where the stock is trading. So, for example, if the stock's trading at $30, I can look at the June options and look at the $25 or $20 calls that are expiring in June, right? That gives me the right to own stock, either at 25 or 20, depending upon which one we're going to buy. And it allows me to participate in the market because I'm only going to pay a premium for that right. That right for each contract is 100 shares. So we're going over the mechanics of how we basically now have used a proxy for the long stock, right? In the traditional covered call, we're going to use an in-the-money, longer-dated option. We're going to sell a shorter-term option against it. So something, for example, that will expire in April. So let's say the stock's trading at 30, I might sell the $35 calls against the $25 calls that I purchased. Now, one thing that I want to note is that we are going to sell a near-term option, the shorter-term option, for at least the amount that will take care of the time value or extrinsic value that during that time period, right, usually around 45 days, in that longer-term option. Or to put it more simply, folks, the net debit that you pay is no more than 75% of the width of the strike prices. So you remember, I'm selling the $35 call, I am buying the $25 call, that's $10 between those strike prices. I cannot pay more than $7.50 for that spread. So the goal is to pay $7.50 or more. Why is that? Why are we using that math and 75%? Because let's say that tomorrow the stock goes from 30 to 35. Well, if I had overpaid for that spread, it may not move in my favor. As a matter of fact, if it starts moving to 35, 40, 45, I could actually start losing money and have to wait until expiration. But if it goes far enough, I won't have an opportunity before expiration to get out. I'd have to sit and wait. Okay? So, with that being said, let's jump in and actually look at the mechanics of covered right. And so first of all, the first thing that I always do is look at a benchmark, whether it's something like the S&P 500, the NASDAQ, the Russell 2000, or a sector ETF. And in this case, I want to look at the finance sector, and specifically XLF. This is a chart, and all I want to do is just get a perspective, a view of what's going on in finance. And we can clearly see that finance has been basically in a very tight range up until February. It has hugged its 50-day and 20-day moving averages. So to me, that's saying that the trend is bullish and it's to the upside. And we see momentum to the upside. In other words, you see that the moving averages are well below the current action. Now, there is a pullback today. So this is a great example of how I like to buy on weakness. And in this sector, which has had strength and could have even more upside, even though it's had an impressive run with names like Morgan Stanley, Citigroup, Bank of America, and Goldman Sachs, which, by the way, is the stock that I want to take a look at, because Goldman Sachs, today there was an analyst that came out and downgraded the stock from neutral to sell. They moved their price target from 140 to 190. Now, I'm scratching my head because the stock's trading at 247. It's been in a bullish trend, and as you can see, the trend of the stock actually looks an awful lot like the overall market ETF that tracks finance. Consolidation, a little bit of a pullback. Did challenge the 50-day during, it looks like this is earnings, or end of the year. And then it rallied up just like the finance sector in general. It's up, the stock year to date and over the last 52 weeks is up, or actually since the election, is up about 32%. So it's been ready for a pullback, and we're seeing a little bit but today. Again, the levels that I'm going to watch very closely are support levels at 242, which is the 20-day moving average, and 240, which is the 50-day moving average. All right, this is starting to help me think about strike selection. Where do I see support? We're always obviously at new highs, right? So there's resistance really is now coming in at that 250 and some change, between 250 and 255. And I have support at the 50-day moving average at 240. Okay? So this is kind of how I'm starting to think about strike selection and so forth. It gives me a picture. It gives me an idea of support, resistance, and then I jump in and now I start building the strategy. And here I'm going to scroll down and I'm going to start looking at the expiration months. Now you might start asking, well, first of all, how are you determining what you're buying and what you're selling as far as expiration months? I always want to sell an option that has about 45 days, 45 to 50 days to expiration. That expiration cycle is going to be April on the sell side. On the buy side, well, really it's based on your forecast. If we get a pullback here in the next couple weeks, next month, I want to give myself some time to rewrite. So basically, I want probably somewhere between 90 and 120 days. Sometimes you can go as far out and use leaps, as we discussed this week when we talked about stock replacement with leaps. You can actually go out as far as 12 to 24 months. In this case, we're going to look at the June expiration cycle, which gives us about 4 months, or about 120 days. And so I'm going to look at the 240 calls, 235 calls, okay? Currently trading $19.95 at 2015, okay? So I'm going to buy those. Why? Well, one of the easy things is I look for about the 70 to 75 delta option on the longer term option that I'm purchasing as a proxy to the long stock that I would normally buy. Now, to buy 100 shares of a $247 stock, that would cost me $24,700. Well, I may only have $25,000 in my account. I am not going to put my whole account in one stock. So this gives me the right, by clicking once, you see I'm going to buy the 235 calls that expire in 4 months, and I'm going to pay $20.15, or in other words, $2,015 for the right to own stock at 235, which, by the way, is $12 lower than where the current stock is trading, right? Now, I'm going to look in the April expiration cycle, and I'm going to look on the call side, and I'm going to look at selling the 260 calls. Why the 260 calls? Well, that's about a 30 delta. It's telling me that there's a 30% probability that this option will be in the money at expiration. That means I have a 70% probability that at this point in time, the option will not be in the money by April expiration. Also, another reason why, I click this twice. The other reason why I'm looking to sell that option, and you can see the setup, buying the 235 call, selling the April 260 call, The other reason why I'm doing that is because if you go over and look at the, I want to see, okay. If I pay $255 and I sell these at $355, and actually we'll do the math. If I do these at 20 and I sell these at $355, that's giving me an average cost basis of $16.45. Okay? If I am doing my math correctly, $16.45 is about 66% of the difference between the strike prices. The difference between $235 and $260 is $25. If you take $16.45, divide that by 25, that's 66% of the width of the strikes. Remember, in one of my bullet points, you never want to pay more than 75% of the width of the strikes. That basically means that you'll be able to take care of the time decay, and if the stock moves quickly, very early in the life cycle of this particular strategy, it'll basically have enough to cover it. Now, the MBBO on this, if I pay 23, so we'll put it in at $16.55 and see what we could actually get on this one. I'm going to scroll down. And remember, this is for a debit, so I'm going to put a limit. Debit 16.55. And I'm going to do a day order only. We'll review the order. Of course. I'm going to do one contract. Why one contract? Well, basically I have a $25,000 account in this particular virtual account. So I'm going to use good capital management. I never have more than probably 5-6% in any one position. In this account, you could get as high as maybe 8%, and I placed the order. And so now what you're seeing is how I basically, and you can see I was filled, I can now manage this particular position by going to manage my positions. And now you're going to see that I have this poor man cover call where I bought the June 35 calls, I sold the April 260 calls. I collect 355, I paid 210, okay? So you can see that my net average price is $16.55, which is less than 75% of the difference between the strike prices. How I will manage this trade going forward is I will roll this either from April to May when those are listed, when this is 50% of the total credit received. So basically when it's trading right around $1.70, I will close this particular option and roll it to the next month and continue the strategy. Or if I have a profit, right, my max profit, let's say between now and April expiration, Goldman Sachs goes to 260, my max profit on here at 260 is $980. My max risk is $1,655. And again, I have 4 months for this to work out, and I can continue to manage this short premium, which will offset any time decay or pullback by this amount, $355, the credit received. All right, folks, that is how you trade a poor man's cover call. Come back at 3:30 Eastern time. I'm going to be going over Tech Talk, where we're going to be taking a look at charts and option analysis so that we can actually get an estimated move for stocks that have been on fire. And that's in Tech Talk. See you here at MarketStream.live, 3:30 Eastern time.